Gold is a strange investment. It pays no interest, produces no profits, and unlike a share or a bond, there's no stream of future cash flows you can use to work out what it should be worth. And yet, central banks have been buying enormous quantities of it. Some of the best investors in the world keep a permanent allocation to it, and I own gold in my own portfolio. So why? In this video, I want to look at 4 different reasons for owning gold. One reason to be cautious, and then look at the evidence for how much gold you should own and the best way to own it. The first reason for owning gold is probably the oldest. It's a store of value. Gold has been valued for thousands of years, long before pounds, dollars, or government bonds existed. Empires have risen and fallen, currencies have disappeared, and monetary systems have repeatedly changed, but gold has survived them all. Part of the reason is its scarcity. All the gold humanity has ever mined amounts to only around 220,000 tons. Spread it across a single football pitch, and it would only be the height of a person, around 1.6 meters. And despite all our modern mining technology, we're only adding around 3,500 tons each year, around 2 to 3 centimeters per year in our football pitch example. Governments, of course, don't face the same physical constraint when it comes to money. And I think this chart is a good illustration of why that matters. This chart shows the purchasing power of the US dollar from 1792. For much of this period, the dollar was ultimately anchored to gold, which imposed a degree of monetary discipline on governments. If too much money was created relative to the country's gold reserves, maintaining convertibility became increasingly difficult. The shaded areas are periods when that constraint was suspended, usually because of war or financial crisis. And there's an interesting pattern. During the War of 1812, the Civil War, and the First World War, prices rose and the purchasing power of the dollar fell quite sharply. But when monetary discipline was restored, much of that loss was subsequently reversed through deflation. The Civil War is perhaps the clearest example. The Union issued greenbacks, paper currency that wasn't convertible into gold, to help finance the war. Consumer prices rose by roughly 75% between 1861 and 1865. But the US eventually committed to returning to gold convertibility, and the dollar's purchasing power subsequently recovered substantially. The 20th century looks very different. In 1933, Roosevelt suspended domestic gold convertibility, and the following year the official gold price was raised from $20.67 to $35 an ounce, effectively devaluing the dollar against gold by 40%. There was still an international constraint under Bretton Woods after the Second World War, with foreign governments able to convert dollars into gold at $35 an ounce. But persistent US deficits and the growing stock of dollars held overseas eventually made that promise increasingly difficult to maintain. And in 1971, Nixon closed the gold window altogether. That's the second red line on this chart. And what happens afterwards is striking. Once the final link to gold disappears, the earlier pattern of inflation followed by deflation disappears with it. The price level essentially becomes one way, and the purchasing power of the dollar continues to decline. Since 1900, US inflation has averaged only around 2.9% a year. But compounded over 125 years, you now need roughly $38 to buy what $1 bought in 1900. So if fiat currencies lose purchasing power over time, the obvious question is, has gold actually preserved it? This chart shows the gold price after inflation, so we're looking at its actual purchasing power. And since 1900, gold's real value has increased around 5-fold in dollars. And for British investors, the increase has been more than 12-fold in sterling. So over 125 years, gold hasn't merely preserved purchasing power, it's increased it substantially. And I think that matters when you look at government finances today. US government debt rose dramatically during the Second World War, reaching around 106% of GDP in 1946. But over the following decades, strong nominal growth, relatively low interest rates, and periods of financial repression helped bring that debt burden down. Today, the direction is reversed. Debt is already around the size of the US economy, and on current projections is heading substantially higher than the post-war peak. High debt doesn't automatically lead to inflation, but it creates some uncomfortable arithmetic. Governments can reduce debt through spending cuts or higher taxes. They can grow their way out of it. They can default or restructure, or they can reduce their debt's real value through inflation. And inflation can be particularly attractive because most government debt is denominated in nominal terms. If prices and nominal incomes rise, yesterday's debt becomes smaller relative to the economy, while the purchasing power returned to the bondholder falls. This can happen through financial repression, keeping interest rates below inflation so governments can finance themselves at negative real interest rates. And that's where I think the monetary argument for gold comes together. Governments can create more debt, central banks can create more money, but they can't create more gold. JP Morgan put it rather more succinctly when he testified before Congress in 1912. He said, "Gold is money. Everything else is credit." A government bond is someone else's liability. A bank deposit is someone else's liability. Gold isn't a promise from a government, a central bank, or a company. It just exists. And that's ultimately the first reason to own it, as a long-term store of value outside the monetary system. The second reason I think gold can be worth owning is as a form of portfolio insurance. You don't buy home insurance because you expect your house to burn down. You own it because, however unlikely, the consequences would be severe if it did. Gold can play a similar role in a portfolio. This chart shows how gold, global stocks, and global bonds performed through a number of different crises. Gold isn't perfect insurance. During the dot-com crash, global equities fell 25% and gold fell 7% as well. But during the global financial crisis, equities fell 46%, while gold rose 37%. During the sovereign debt crisis, gold rose 15%, and during COVID, while equities fell 21%, gold gained 4%. So gold doesn't simply move in the opposite direction to equities, but there have been some very important crises when owning it provided significant protection. And there is an even more extreme version of this argument. Imagine a severe banking or currency crisis, capital controls, war, or a breakdown in parts of the financial system itself. Physical gold doesn't require access to a brokerage account or even functioning financial markets. I'm certainly not building a portfolio around the collapse of society. If that happens, my asset allocation will probably be fairly low down on my list of concerns. But that's the point of insurance, protecting against events you don't expect because the consequences could be enormous. And gold has one unusual advantage over most portfolio insurance. If you continually hedge a portfolio with put options, you're constantly paying an insurance premium. The options expire and you have to buy them again. Gold doesn't expire. It's an insurance policy that investors have been paid to hold. Gold won't protect you against every crisis, but historically there have been some very important moments when you've been extremely glad to own it. The third reason is one that has developed over the past few years. Central banks themselves have been buying enormous quantities of gold. For much of the 90s and 2000s, central banks were actually net sellers of gold. That reversed around 2010, and more recently, the scale of buying has been massive. Central banks bought more than 1,000 tons in each of 2022, 2023, and 2024. Buying fell to around 860 tons in 25, but this year looks like another big buying year. So why are they buying? Diversification is part of it, but geopolitics is increasingly important. Following Russia's invasion of Ukraine in 2022, Western governments immobilized roughly 300 billion of Russian central bank reserves. This sent a powerful message. Foreign reserves held within another country's financial system can potentially be frozen. Gold held domestically can't be frozen in the same way. And this second chart is interesting in that context. Between 2015 and 2025, many of these countries increased gold as a share of their reserves while reducing their dollar exposure. Russia is the most extreme example. Gold increased by around 21%, while the dollar fell by 22%. China increased gold by around 6 points, while its dollar allocation fell by around 17. India shows a similar pattern. Now, some of that increase in gold's share is simply due to the rise in gold price, and this chart doesn't prove countries are replacing dollars directly with gold. But combined with the purchasing data, it does suggest a broader shift. Some central banks want less dependence on the dollar and the US-led financial system. That doesn't mean the dollar is about to lose its reserve currency status, but if central banks simply decide to hold a little less in dollars and a little more in gold, that's potentially a significant structural source of demand. The fourth reason for owning gold is diversification. Gold itself can be volatile, but what matters in a portfolio isn't just the volatility of an individual asset, it's how it behaves relative to everything else you own. Since 1972, gold's correlation with US equities has been just 0.01, and with US bonds, 0.06. Essentially, no correlation at all. That means gold can potentially reduce overall portfolio risk, even though gold itself isn't particularly low risk. And you can see that here. Over 20 years, this hypothetical diversified portfolio without gold returned 6.7% a year with volatility of 9.9%. Adding just 5% gold increased the return to 7% and reduced volatility to 9.6%. And it also reduced the maximum drawdown from 34.9% to 32.7%. And the same pattern appears over the 3, 5, and 10-year periods. Now, gold has performed extremely well over this period, so I wouldn't assume it will increase future returns. The more important point is that gold has historically behaved very differently from both stocks and bonds, and that's what makes it such an interesting diversifier. So there are some strong reasons for owning gold, but price still matters. Gold has risen extraordinarily quickly over the last few years. That doesn't make it expensive. Gold is notoriously difficult to value, but it does make me cautious about chasing recent performance. And there's another reason for caution: real yields. Gold produces no income. So when the real yield available on government bonds rises, the opportunity cost of holding gold rises as well. Historically, that's been an important relationship. Higher real yields have generally been a headwind for gold. But after 2022, something unusual happened. Real yields rose sharply, yet gold continued to rise. One explanation is the enormous central bank buying we've already looked at. Central banks were buying for strategic reasons and were therefore less sensitive to the return available elsewhere. For a while, that demand appears to have overwhelmed the traditional relationship. More recently, though, real yields appear to matter again. And if investors can earn an attractive inflation-adjusted return from government bonds, An asset producing no income has a higher hurdle to clear. Gold has also recently become more sensitive to movements in both bonds and equities, potentially weakening some of the diversification benefit we looked at earlier. None of this destroys the long-term case for gold, but after such a rapid rise in price, it does make me wary of assuming that what has worked exceptionally well over the last few years will simply continue in the short term. So if you think there is a case for owning gold, how much should you actually own? There's certainly no consensus. A few model portfolios have different suggestions. William Bernstein's no-brainer portfolio doesn't allocate anything to gold at all. So despite everything I've said so far, you certainly don't need to own gold to build a diversified portfolio. The all-weather portfolio, commonly associated with Ray Dalio, allocated 7.5% to gold. The Golden Butterfly goes further with 20% in gold. And Harry Brown's permanent portfolio allocates a full 25%, alongside 25% each in equities, long-term bonds, and cash. So depending on whose portfolio you look at, the answer can be anything from nothing to a quarter of your portfolio. But real investors are generally not holding much in gold. JP Morgan's latest survey of family offices found that fewer than 30% had any allocation to gold, and the average across the whole sample was less than 1%. So rather than just looking at what other investors do, what does the research suggest? One study looked at adding gold to a traditional 60-40 portfolio over the 50 years from 1973 to 2023. With no gold, the portfolio had a risk-reward ratio of 0.95. That improved as gold was added, peaking at 1.05 with a 17% allocation. But I wouldn't focus too much on 17%. Allocations from roughly 10 to 20% produce very similar results, and anything between 1 and 34% improve the historical risk-adjusted return. So there's no magic number, but the research does suggest that a meaningful allocation to gold can improve the risk-reward characteristics of a traditional stock and bond portfolio. This brings me to the way I prefer to think about it. Own enough to make a difference, but not so much that gold starts driving the portfolio. If gold has a big year and rises 50%, and you've only got 1% invested, it adds just 0.5% to your portfolio. That's not doing much. So if gold is partly there as insurance, a very small allocation may not actually provide much protection. But the maths works both ways. With 20% in gold, a 50% fall would knock 10% off the whole portfolio. At some point, the insurance starts becoming one of the main risks. In my own portfolio, I currently have around 4% directly invested in gold. That might seem quite low given everything I've said in this video, but I think the allocation has to be considered alongside everything else in your portfolio. My portfolio is already very defensive. I hold substantial amounts of cash, inflation-linked bonds, and defensive funds, so gold isn't the only form of protection in the portfolio. I'm also a little cautious about gold at the moment. It had an extraordinary run, and recently it's sometimes behaved more like a risk asset than a traditional safe haven. That doesn't undermine the long-term reasons I own it, but it does make me reluctant to increase the position significantly at today's price. So for me, 4% is enough that I still participate if gold continues to rise, and enough to provide some diversification without relying on gold to protect the portfolio on its own. I still like gold and I want to own it. I just don't think I need a particularly large allocation given the way the rest of my portfolio is constructed. Now, there are broadly 3 ways to get exposure to gold. Own physical gold, use a physically backed exchange-traded commodity, ETC, which is like an ETF, or buy shares in gold mining companies. Physical gold is the purest form. You actually own the metal. either in a sock under the bed or in some form of storage. And if part of your reason for owning gold is protection against a serious failure of the financial system, there is an obvious attraction to owning something that doesn't depend on that system. The downside is practicality. You have to buy it, store it securely, and potentially insure it. And there are also dealing spreads to consider. For most investors, the simpler alternative is a physically backed gold ETC. These hold physical bullion in vaults and give you exposure to the gold price through something you can buy and sell through a normal investment account. They're cheap, liquid, and easy to rebalance. The trade-off is that you now own a financial security backed by gold rather than the gold directly. And then there are gold miners. Gold miners can behave very differently from gold itself. You can see that particularly clearly over the last year. While physical gold has risen substantially, gold mining shares have risen much further. The reason is operational leverage. Imagine gold sells for $3,000 an ounce, and it costs a miner $2,000 to produce it. That's a $1,000 margin. If gold rises by a third to $4,000 and costs don't change, the gold price has risen 33%, but the miner's margin has doubled. That's why miners can potentially produce spectacular returns during a gold bull market. But that leverage works in both directions. Miners have wages, energy costs, and capital expenditure. Mines can underperform, governments can increase taxes or royalties, management can make bad acquisitions, and new supply can be expensive to develop. So you're not really buying gold, you're buying an equity whose profitability is heavily influenced by gold. And the distinction becomes clearer if we zoom out. Since 2004, $1,000 invested in gold would have grown to more than $6,000 by the end of 2024. The same $1,000 invested in the gold miner index would be worth less than $2,000. I owned gold miners through much of that period, and it would have been much better for me to just buy gold. And the journey was considerably more painful. Over this period, the maximum drawdown in gold was around 45%. For gold miners, it was around 80%. So I wouldn't buy miners as a substitute for the insurance role I've been talking about throughout this video. But that doesn't mean miners are necessarily unattractive investments. One of the arguments for gold miners today is actually valuation. Despite their recent surge, miners spent many years dramatically lagging the rising gold price. If gold remains at these elevated levels and miners can control their costs, those high gold prices can translate into substantial cash flows and profits. So I think of the three options quite differently. Physical gold is the purest form of ownership and gives the greatest independence from the financial system. If you are scared of the world as we know it ending, buy some gold coins and hide them in your house. A physically backed ETC is probably the most convenient way of getting direct gold exposure in an investment portfolio. And gold miners are something different, a much more volatile equity investment with potential leveraged exposure to the gold price. For the role I currently want gold to perform in my portfolio, direct exposure to the metal via an ETC makes the most sense for me. Gold may rise or may fall. No one can tell you what will happen next. But owning gold is about owning an asset that has survived currencies, governments, and financial crises for thousands of years, and I suspect for thousands more years to come. Thanks for watching.